Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is April 10th, 2025, and we're going to talk about inflation, earnings season, and where we're at in sector rotation for the business cycle. Beginning with this move in the S&P 500, we can see that we've had massive amounts of volatility. We've seen drops of 15 to 20%, recoveries of 10%, pullback of 5%. Today alone, we've dropped about 6.5–7% and recovered to be down 4%. And we're just seeing a ton of volatility and a ton of uncertainty in this market. And part of that is, are we going to see the tariffs? Are we going to see the impact of the tariffs? Have we seen all that we're going to see of the tariffs? And has there been damage done that we haven't seen yet in pricing? That's what we don't know. And I think the market is trying to find price. One of the things that Gianni and I commented on together was we're in a situation where the market is trying to do price discovery, but it's not finding where price is to be discovered. It can't find where there's buyers and sellers. It can't seem to find a clean level to be defensive or to sell or to take advantage of the moves. And so it's very violent, very volatile, and inconsistent. But if we look at the data going into this, we can start with the CPI data. US CPI came in lighter than expected. Core CPI, meaning ex food and energy, is 0.1. So a little bit up from the previous month, but down from the previous expectations and the forecast. CPI total, including food and energy, is negative 0.1. That is disinflationary, but 1 month doesn't necessarily take down the year. As you can see, we're down 2.4% versus 2.5, and the previous was 2.8. So we are slowing down, but we are not going negative. So this is still inflationary, but less inflationary. The data would seem to support that we are not seeing the inflation if there is going to be the inflation impact of the tariffs. Now, that tariff impact, if we're talking 90 days out, is going to be seen. Even the delays in shipping and the increased costs and the pauses and the changes in cost of shipping and the blockades that have already been established will have an impact to inflation. And if we see that later on, it could be significant. We're not sure, and that's part of the reason, again, the market's having a hard time finding how to price. Now, one of the things that will have a direct impact is on the business cycle and on what we're going to see in earnings and earnings guidance. If we look at the standard business cycle, one of the things that I like to watch for is where are we at based off what we're seeing happen in the sectors. Where could that tell us we're at in the business cycle? And everything seems to support the ideas that general commodities, which would be industrial commodities, not gold, general commodities are beginning to fall. Consumer staples are doing well. So these tell you which direction they're going. These are the sectors that generally do well at this point in time. So we are still seeing defensive sectors and consumer staples act as somewhat a defensive area, including utilities. They've been able to maintain a little bit more bullishness even in this massive sell-off. They're not selling off as far. And we're looking for that next GDP number that comes out here in 2 weeks. I believe we're right here, early contraction. That we're trying to decide if we're going to see a situation where we are confirming what many are suspecting, and that is that we're already in a recession. We just need to see the data prove out. If that's the case, fine. We'll know where we're at, and then we'll be looking to continue to buy into consumer staples utilities. If we're not there, if we're seeing that inflation is rising and maybe we're over here, the energy is starting to push higher, then we should start jumping back into this late expansion behavior because bond prices are falling and we could see commodity prices bounce back up. So if bond prices fall and commodities bounce back up, that's what we need to be paying attention to if that's the case. So I think that's really the only two areas that I can see from a sector rotation perspective. Either we're beginning this early contraction and looking for that recession, or it's a head fake and we're really still late expansion and we're going to see inflation turn back higher and commodity prices rise and bond prices continue to fall. And that's where we're at today. But this earnings season could be very telling as well. So I'm watching earnings very carefully, and I'm watching because we start out with financials. If financials aren't recovering, if financials are not bouncing, then we can't be in full recession because financials have a tendency to be this safety net when we're in full recession. That's when they bottom out and start turning higher. So if we see poor guidance, if we guide lower from the banks, no matter whether they have good earnings or not, if we guide lower, it would tell me that we're not quite here, and so we have to be in early contraction or again during this expansion if we continue to sell off in financials. And that's what's going to be seen. I think there's a likelihood that's going to be the case. And as we look at the earnings, we start with JP Morgan, Wells Fargo, Morgan Stanley, BlackRock, Bank of New York Mellon tomorrow. And then Monday we have Goldman Sachs, M&T Bank. Tuesday, Bank of America, Citigroup. So it's primarily financials. Yes, there's some others mixed in there like Fastenal. And that's really overall, we're talking financials. So we're out the gate with financials. JP Morgan is the biggest, and we're watching them. They have a $630 billion market cap. We don't normally expect a $13 move in JP Morgan. That's what's being priced in to the earnings. And so if we see that kind of a move, that would be surprising. But we could actually see bigger if they miss on earnings and then guide lower, because frankly, many of the financial institution CEOs and others have already guided that we're probably already in a recession. And so if that's the case, watch for these to not only miss, but watch for them to miss and guide lower. That would tell us that we're not quite to the lowest part of the recession where we start seeing stability and recovery or a market bottom. And these banks are the ones that are going to set you up for that move. If we look at XLF, XLF had an amazing channel. We've been talking a lot about channels in the main room. And has an amazing channel that broke out, duplicated the channel, broke out, duplicated the channel. And it's interesting to me to see, even though this channel was done last year at this time, we've still respected it even with this volatility. If I duplicate this and drag it up, you can see that we played up to that level, oops, and then back down. And then we fell back and duplicated the channel down here again and bounced up. And so here we are at this cusp. Above it, below it, above it, below it, above it, below it. If we bounce at 45 and have positive earnings and positive guidance, and we're probably going from 45 to 48, we're talking about an 8 or 9% recovery in XLF, the broad sector ETF. If we see it miss and go lower, then I'm looking for about an 8 or 9% drop back down to this low. But if it breaks there, now we're talking about a $6 move and a 15% correction to bring us down to 41. That JP Morgan being one of the flagships that we're really looking at to have the impact on XLF, are we looking for the same thing here? If we're talking about 8% and possibly 15%, 8% move on 224 is going to give you about a $17 to $18 move. That's beyond the $13 expected move. A $13 expected move is going to bring you right here to 210. I'm looking to potentially drop down to 205, if not 200, if they guide lower. And JP Morgan will be the albatross or the weight that holds down the financial sector. If that's not there, do not expect that we're going to find the base and start recovering yet. Until we see financials bottom out, I would not trust that they're going to reverse. If we want to tie closer to what is a bigger concern to me, then I'm going to go look at Visa and MasterCard. Visa and MasterCard are a good representation of, yes, financials, but they're also a good representation of consumer spending. Visa makes their money not off of interest rates, but off of transactions. So if we have less and less transactions, we're predicting pricing in lower transactions, then we're going to see this sustain its break that we already saw in the channel. Notice it traded the channel, even though the channel is way back here. Even with this volatility, we dropped down to that channel height, retested the highs, and it looks like we've rejected it. And this channel's width is about $25. So if we break through the downside, we're talking about another 8% lower or 16% from where we tested yesterday. Almost perfectly. And if we're seeing this is a full set, lower highs, lower lows, lower highs, lower lows. Clearing this low, we would and could see 270, 280. That is an indication to me that we are not pricing in that the consumer is healthy, and we're probably looking for the next leg down. Their earnings are not until May, and so we'll see them come in later. But the price pattern is getting wide, but it's still respecting these same channels. Same thing with MasterCard. I'm going to duplicate this channel, and we can see there's the break of the channel played down to the lows. There's the break of that channel played up to the highs. This one's a little bit lower on the gap, and to me, today is the confirmation from MasterCard that we're really not looking that great. I expect us to retest 471 and then potentially drop all the way down to 440, giving us a 10 to 15% drop in MasterCard. So again, financials are and have been something that will guide us as far as where we're at in the business cycle, but credit cards, Visa and MasterCard specifically, are the transactions, and I've always called those the canary in the coal mine, as far as how the global economy is doing. Not just the U.S. economy, but the global economy, because the U.S. is the biggest consumer in the world. And it doesn't look good. In that same realm of financials, let's take a look. And by the way, every one of these breakouts is an opportunity to take a bearish position, a long put vertical, selling call verticals since the premiums are so high, up above 515 on MasterCard. But some of the other areas that we'd be looking at, and I've talked about, that stocks like CarMax. CarMax has been terrible. I've been extremely bearish on CarMax this entire time because they've used their own financing to create demand that really wasn't there, which means this is going to really hurt them. And sure enough, earnings really hurt them. They're down 17% off of earnings. They're down almost 18% off of earnings from yesterday's close down here, $15 off of 80 some dollars. And CarMax does not look like we're going to see a recovery here, as we've closed down, or going to close down below the 52-week low today. Off of earnings, there's more downside. In that same realm, I would look at Capital One Financial and Ally, COF. COF is a breakdown as well. We can see it looks almost identical to Visa, but it's a lot lower off of its highs. I'm looking at COF to fall back down to about 145 and then potentially go for that 52-week low. COF, Capital One Financial, does a lot of auto loans, and auto loans are a higher cost right now, higher interest rate, and the cost of cars and used cars is through the roof, and so they're going to have a harder time collateralizing the debt because used cars are so high priced. If we look at Ally, similar story. Ally is not your cleanest financial lending for consumers. We already broke through the 52-week low on the gap. We've retested it as resistance. We haven't even hit earnings, and I think Ally has another leg down of at least 10 to 15%. Again, you might sell the call verticals up here at 34 or buy a put. All of this is just setting us up to say financials are struggling. And if financials are struggling, then consumer discretionary is probably going to struggle. The bounce and recovery that we've already seen is probably temporary lived until we see and shake out what is happening next. So it doesn't look that promising. I'm looking for the next leg down, specifically in financials, and I'm going to be using financials bottoming out to help me decide when the entire market is bottoming out before we step in to go overall bullish broad market once again. That's going to do it for me today. Join me again next week. Certainly join me tomorrow in the TheoTrade main room and in the futures room. Have a fantastic day, and we'll talk again tomorrow.